what is a stock market and what are stock shares. When I started investing, I had no idea. Of course, it sounds like money, and obviously we're gonna make it really simple for you to understand. In Britain, they came up with this idea that a person, they can form another identity in the shape of company, and they can start any kind of business. So the company considered as a separate entity. It's complicated words, but I'm gonna make it simple for you. So if I start a business as a person, not as a company, and tomorrow if something will happen and I become bankrupt and the court will order to seize my assets, my all the personal belongings can be seized as well. Everything which belongs to me can be seized because I am, as a person, I was trading, and then obviously I'm liable for anything which will happen in the future. With the company, when you shape a company, when you form a company, the company is considered as a separate entity. So if tomorrow something will happen, all the assets which belongs to company will be seized, not belongs to any person. So company is a completely separate identification. It's a separate institution. All the liabilities on that. Initially, the way the company works, obviously they need money to run a business. In most cases, in the case of small companies, the company director or there is any other shareholder or partner, they will obviously put the money inside a company and then they will start trading. There are some cases like we have seen in Dragon Den, or the shows like this are very famous in America or in UK as well, where they go and they raise the money from a private investor or a private angel investor or a private investing firm or anything like that. This is the stage where they raise the money from a private institution or investor or an angel investor. So in exchange of that, what they offer is a share in a company. So if I come to you, I say, look, I have this company, I will give you 25% of it. In exchange for that, you have to put like £100,000 in a company. So if tomorrow, if I will make, let's say, £100,000 profit from a company, I will give you 25% of it, which will be 25,000. So depending on whatever the share structure or stuff like that will be happen. Now, what's happened when the company go public? This is where the stock exchange, this is where your initial public offer, this is where your investment banking, all those things comes in as well. So tomorrow I decide, okay, well, I need to go public in order for me to raise more money as a company. I will contact some investment banker like JP Morgan, or there are many of them out. So what they do is they will do the initial assessment on my company, and they will do something called IPO, which stands for Initial Public Offering, which will actually value the price of the share to the public in my company. Either it will be $500 or $600 or I don't know, $1 or $2, depending on how my company is trading. If I need to take my company to the public, I will contact the investment bank, and then they will do initial IPO, and then the stock exchange will actually list my company for the public to buy the shares. The company is a separate identity, is a separate institution. In the beginning, company raised the fund from private investors. So if they will decide to go public, they will go with the investment banker, and investment banks will actually do the initial public offering IPO. Then the stock exchange will actually list my company, and then public can buy the shares from my company based on whatever the IPO is for the company.